Welcome to the Money and Mortgages podcast. I'm your host, Adam Coleman, accredited financial counselor and mortgage planner. Join me as I speak with fellow industry experts on all things personal finance. Well, welcome everyone. This is your host, Adam Coleman, and with me today I have returning to the show, Doug Tees. He's a certified financial planner with Jason Howell Company, and today we're going to be doing a deeper dive into health savings accounts, or HSAs for short. So, Doug, welcome back to the show.
Thanks for having me, Adam. Great to see you again.
Well, yeah, no, always a pleasure talking with you. So I appreciate you taking the time to kind of go through this. Obviously, this is kind of a big topic nowadays. Obviously, it wasn't years ago. This is kind of a relatively new kind of concept. But I guess jumping in, tell us a little bit about an HSA. So, like, who qualifies for it, and kind of what is it about?
Sure. An HSA, probably easiest terms, what people are most familiar with is it's similar to a flexible spending account, but with two great perks. First, unlike the flexible spending account, it's not use it or lose it. So you get to keep the funds. You don't have to worry about, did I actually select the right amount to withhold and save on taxes, or am I going to lose some of this? So that's a huge perk there. The second is you can actually invest the funds similar to your 401k. So you're able to grow those funds over time. And that's really the key differentiator for HSAs, and what makes them really attractive for folks to save in a unique way for healthcare. The biggest positive about a health savings account is it's the only triple tax advantaged vehicle that's out there. So you defer taxes when you save, so you're not paying taxes on your income that you're putting away in there. It can grow tax deferred, so the investments, as it grows over time, you're not paying taxes. And then if you withdraw it for medical expenses, you pay no taxes on the growth or the gains. So wonderful aspects to that. You asked about who's qualified for it. Well, you have to be on a high deductible health plan in order to qualify for that. So the high deductible health plans are deductibles for individuals of at least $1,600, for couples of at least $3,200. So you have to be there. The plan also has to have a max out of pocket that doesn't exceed $8,050 for individuals or $16,100 for families. So that's kind of the parameters for the plans that allow you to participate in the health savings account.
Nice. And generally speaking, in terms of how the plans are set up, it's almost like you have the high deductible plan for people trying to differentiate the two. Generally speaking, I think if they really have a copay type of scenario, that's not typically a high deductible plan. Usually it's kind of out of the non-copay system, correct?
Actually, you do have a copay, but with the high deductible plans, typically you're paying the full bore for your healthcare costs until you hit
Right.
that deductible. Once you hit that deductible, the more traditional plan elements typically kick in, where you're paying 20% and the health insurer is paying the 80% until you hit that maximum out of pocket. Hopefully nobody does, but in worst case scenario where you do that, and then the plan takes over. So the catastrophic limits are hit, and then you're not out of pocket from that point forward.
Right. You mentioned the investment piece, and I think that's always the most optimal way of doing this, but I think a lot of people don't fully grasp that. So obviously with a health savings plan, you can invest it. A lot of people just take advantage of the pre-tax contributions and then they use it right away. Is that generally how you would advise, or do you kind of go the opposite direction where you just don't use it at all and then you just invest it long term?
Yeah, where people have the cash flow and funds available to sock that away and save it, that's optimal. That means that, you're saving that pre-tax, you're growing it over time. And we look at it almost like a healthcare 401k. So you can build that up and utilize it maybe in retirement if you have high expenses. This is another way, an alternative way versus long-term care insurance or other ways to help you create a bucket of funds available to you when we expect healthcare to be more expensive. Certainly, people who don't have the cash flow to support the savings side of things, you can take advantage of the tax deduction and then use it as you need it. But again, for folks who have the cash flow, we really love the aspects of that long-term growth and opportunity that the investing side of that allows for.
Right. Yeah. I mean, it's best, there's no harm in using it for sure. Like, at least you get one of the tax deductions from it. You just are missing out on the other two, essentially, if you don't save it up and invest the
Correct.
difference. So
Correct.
how do you see the comparisons between, so some people have the option to choose the high deductible plan or kind of a more traditional, I wouldn't say lower deductible, they're still fairly high, but
Right.
a better, deductible plan. Where do you see the comparisons? Like, how do people really judge, in your mind, of what should I do? Should I do the high deductible plan and do the HSA? Because I do hear that a lot of times. I think people almost chase the concept of an HSA because they hear such good things about it, but then maybe they're putting it themselves into a worse plan overall for insurance purposes. How do you compare those two?
Yeah, we actually do build like a spreadsheet for our clients and do a apples to apples comparison. So you've got, your basic premiums. Typically, the high deductible health plan has lower premiums. So the amount that's taken out of your check every month is less than it would be for more of the traditional plans. The experience, and then, the catastrophic loss limits, what's your out-of-pocket max, and then the savings and what you get to save on taxes are all a component of it. So what you would save in a flexible spending account versus what you can save in an HSA. So as a side note, flexible spending accounts have lower limits. So if you're doing a traditional plan with a flexible spending account, you can only save up to 3,200 as a family. With the HSA, you can save as much as 8,300 as a family, and if you're over 55, you can tack on another thousand. So it gives you a lot more flexibility. And again, the you don't have to worry about use it or lose it for that. So those are the components that go in. So looking at how it flows out, we look at incremental spending. Okay, for the high deductible plan, you're going to be responsible for those first couple $1,000s of medical expenses. That's going to come right out of your pocket. So people feel that a lot more. So a lot of times when people sign up for the health savings account, they don't notice that they're getting more in their paycheck because the withholdings don't, but they sure as heck notice when they have to write a check or scan their credit card at the
Right.
doctor's office and pay full bore for those initial appointments. So the cash flow feels different, but a lot of times the math works out to say, okay, yeah, over the course of the year, as you spread that premium savings over the course of a year, you're spending out of pocket more in the front part of the year, but it evens out over the course of the year. So a lot of times that's what we're looking at. Most of the time, the math ends up working, leaning towards the health savings account. And then especially so for folks who aren't high utilizers, right? So that
Right.
becomes an easy thing because, we look at best case scenario versus worst case scenario and all the way in between. So the best case scenario is you've just paid your premiums. You don't seek any care. Hopefully you go for your annual checkup, but beyond that,
Right.
which is covered 100% regardless of the plan. But if you don't seek any care above that, then you're just out the premium, and that's the least that you can spend. So that's better in a high deductible health plan. So if you're a low utilizer, man, it becomes even more of a benefit to
Right.
go that.
So younger, I mean, kind of generally speaking, do you see that there's really too many scenarios where younger, I guess, healthy individuals that don't really go to the doctor very often, should they really generally almost always go with a high deductible plan with the HSA, or are there scenarios or exceptions to the rule for that?
Yeah, there's always exceptions and it's always individualized, but yes, generally you're paying off better because your utilization is so much lower. What we do is we do look at worst case scenario because health insurance, like many insurance, when you think about it, it's really to protect you against the worst case scenario.
Right.
So we end up looking at that end of the spectrum with a little more weight sometimes than that low utilizer, right? So even the low utilizer could have a surprise diagnosis or something like that. So we do look at the the whole the outside end. And even then, oftentimes you're still better off with the health savings account. One other thing that tends to tip in the balance of the health savings account and the high deductible plan is a lot of employers will actually contribute to that health savings account, sometimes even
Right.
as much as the deductible. So that's free money, and so that goes into the mix too, and the math as well to say, okay, yeah, this as our family will do better. But I can't emphasize enough that the feeling of the health savings account and health savings plan often feels much more challenging because you're putting that cash out. And if you're following our other advice about not withdrawing from the HSA, well, now from a cash perspective, you've just socked away an extra 8,300. yeah, you're paying a little less on premium, but you're paying all of your healthcare out of pocket. So you feel that pinch a little bit more. Overall, you're better off. You're growing your assets, you're growing your flexibility for how you can handle retirement and things like that. But, today's dollars and cents may feel like a net negative, even though overall it's positive.
Right. No, and certainly from a budgeting standpoint, it definitely adds some wrinkles into the mix. Definitely that you have to plan on. I've had both, and it definitely does feel different having going to the doctor and you're not paying $25 for a copay. You're like, oh, it's a $300 bill that you've got to deal with because you had to pay for the whole thing. So it is a different mindset shift that you have to deal with for sure. Sometimes, so like there's situations where you can be eligible for an HSA, but most of the time the employer provides some sort of plan that you can go into, but you don't have to use their plan, correct? Like you can obviously go outside and shop that around to a different HSA provider. Fidelity or any kind of brokerage typically has some sort of option or bank. How do you compare those generally? Do you just usually just go with the employer's option, or do you ever go outside of that?
Yeah, typically we end up going with the employer's option. There are some good ones out there. I think Fidelity, and there's a couple others. I shouldn't, plug any individuals, but yes, you can. What ends up happening if you're doing it outside of the traditional employer where they withhold and they do everything, you can make a contribution to that, and then you just kind of correct for it in when you file for your taxes. So essentially you get the deduction at the back end instead of when they automatically withdraw from your paycheck, they are taking it pre-tax and handling all of that heavy lifting for you. One of the things with HSA plans is they're a lot like 401k plans. So every employer has, contracted with a different organization that supplies those. They have different investment options, they have different fee structures. So there have been a few cases where we've looked and said, wow, this HSA is particularly expensive from a fee perspective and those kind of things. And in those cases, we might consider doing something outside of it. But 9 times out of 10, or even more than that, it's just going with the employer plan just for simplicity and ease of use.
Do you find that most of the situations call for a rollover after they've left that employer, or generally speaking, do they just leave it with the old HSA plan?
A lot of folks have left it, but as you said, it's kind of new, and so we haven't seen as much churn in those accounts as we do in 401ks and as people have left employers over time. So I think there's more to be seen on that. I would recommend consolidating those just because it's hard to keep track and to
Right.
manage investments across. The other issue is most of the HSA plans require you to keep. Typically, it's about $1,000 in cash. That is so that you can, get withdrawals and bills and everything, but it's also to their benefit in that they're able to invest those funds
Right.
as an organization to make money off of them, and you're not. So having multiple of those where you don't have funds working for you in the market is suboptimal. So generally we would want to consolidate those if people are moving to a new employer.
That was a big thing for mine. Like I literally just rolled over my HSA, and just because my old one it was like a $2,000 cash limit,
Okay.
and that seemed a little bit annoying to deal with. Plus the fees were higher. So yeah, I just rolled mine over, and now I can just invest all of it and not pay any fees. So, but I also don't have the ability to do an HSA now, so I don't have a current employer plan to worry about. So this is like an old HSA to deal with. So yeah, it's pretty easy to roll over as well. So for anybody that's worried about going through that process, it's not difficult. So it doesn't take very long to kind of go through that process for sure.
Excellent.
About the investment options, I guess, how do you treat this more when you're going through like investment scenarios or asset allocations, things like that? Are you treating this very similarly to kind of a long-term Roth IRA or, Roth 401k type of mentality where you're choosing those type of investment options, or do you think of it in a different way?
No, absolutely, similar to the long term, especially if folks are able to cash flow the costs out. We look to diversify similar to the way we do with other retirement accounts, and allow for rebalancing, all of the kind of standard similar practices, because again, we're looking for that long-term growth over time.
At what point do you usually see people start, or I guess optimal way to do it? What do you think is the most optimal strategy to start pulling money out of the HSA? Like, is there an age that you think is best? Is there some other factor that comes into play?
Yeah, I think it's a mixed bag. So certainly in retirement to start to fund some of those expenses, especially if you have a large amount already saved in that bucket, you'll want to start pulling from it. But one of the things that people don't often pay attention to that I would like to highlight for anybody listening is you actually should, as soon as you open an HSA, the first year that you're eligible, as soon as you're paying cash out of pocket, is really track those expenses that you paid out of pocket. Have a spreadsheet that tracks them, maybe even keep the bills, keep a folder that you can build that up, because at any point in time, you can take those funds out that you paid out of pocket. It doesn't have to be in the same year or anything. You just have to substantiate that, hey, yeah, those were for medical expenses, so you don't have to pay the any penalty or any taxes on the growth. So you can build up over, your working years a large number of, hey, this is what I've paid out of pocket, and then you can pull that out anytime you need it. So typically we're looking at this as a like a healthcare 401k, so that it's there in case you need to fund long-term care, but it could grow to more than what you anticipate needing, in which case you could start pulling it out for other expenses where you're getting a tax-free withdrawal to fund and do other things that then don't impact your capital gains rate, other things, that some of your brokerage investments might do, or your retirement investments that might impact your income as you file for taxes. So it does give you some great flexibility. Also, if you happen to hit a hard patch in life, or if there is some other goal that comes up and you make a decision that no, this is the highest and best use for those, you've got evidence to substantiate pulling those funds out and using them for that.
I guess, how granular do you see people actually get, or how much advice do you give for people to go like super detailed on that? Like, do you say every medical expense, every eligible thing, or do you maybe balance that with just the hassle of going through and tracking all these expenses? Do you kind of pick the big ones and just track those just to keep it simple? Like, where do you see it in the real world?
Yeah, so with everybody being different, I like to tailor that to what will work for the person, right?
Right.
So an individual who, like me, loves spreadsheets, loves tracking numbers, I track
Right.
everything because it's just how I do, right? So, but there are folks who, come to us for advice, and they want to outsource this. They want to make it as easy as possible. So for them, it's what will they be successful and consistent on? So maybe that's, hey, just catch the stuff that's over 100 or over 250, whatever it is that becomes the threshold for compliance and for being able to do it over time. We want to engineer for success. So being helpful for that as much as possible. Ideally, yeah, you track everything, because then you can come back and it's amazing how those little things add up over the course of years. And I can see it because I actually track all of it. So best practice, track everything. Second best practice is track as much as you can and you're willing to do.
Right. Is, I guess, best case scenario, a fully optimized where people just know that they've got plenty of money to pay for medical expenses, great problem to have, and they've got a ton of money in the HSA. Is there really any kind of deadline for anybody to ever pull that out besides just them passing away? Obviously, like, can they wait as long as they really want to
They
cover long-term care, like, assisted living, that type of thing? Is there any reason to pull it out before then if they don't need it?
There's no reason to pull it out before if needed. Sometimes, depending on what the overall structure of assets looks like if there is a ton out there and we're not worried about being able to fund, long-term care or things like that with other resources, we might choose to bring that out just to be most tax efficient with how we bring things on. And it's not, the best thing to leave to heirs. It's kind of like 401ks, the withdrawal at that point would be taxable. The growth would be taxable as an income.
Right.
So it's not optimal to leave that. It's not terrible, but we might start to draw that down again if we feel like we've got things covered off elsewhere. But there's no penalty for keeping it, no reason to take it out early other than just optimizing among the bucket of, the bucket of assets that you have.
Gotcha. Anything to be considered with for early retirees that are going to go through that don't necessarily have health insurance, from an employer going forward, but you have a large HSA built up. Do you see that that's kind of a good time to start using some of those to cover medical expenses, or is it still better to kind of wait if they have the money elsewhere?
Yeah, it's still better in a lot of occasions. And again, this is a broad brush, so specifics might be different. But if you're retiring early, say at 55 or 60, you've got 30 to 40 years ahead of you of retirement and potential expenses. So a lot of times, if somebody retires early, we're actually going to draw down some of their retirement assets in order to manage the income levels and tax rates, and maybe even do Roth conversions, those kind of things, to optimize taxes while spending from those buckets versus the HSA.
Gotcha. Okay. Any other, I guess, planning considerations that you consider when you're going through an HSA? Anything that's top of mind for you from a financial planning perspective?
Yeah, it does impact other recommendations for folks. So a lot of times, if somebody's in their 30s or 40s and we are building up an HSA now, we keep in the back burner maybe long-term care insurance, maybe there's a hybrid policy that offers long-term care. But if this grows at the rate that we're expecting, if you're able to contribute to it and grow, maybe that takes that future expense out of the mix. A lot of planning considerations that kind of impact one another and flow together. Certainly, the withdrawal strategy in retirement becomes a piece of the puzzle, as well as we're looking at, yes, this is another bucket of funds that's there and that can be utilized obviously specifically for healthcare, but as we discussed, it can be also used for general spending if the healthcare bucket has grown more than what we anticipate needing.
Is there anything you would really prioritize over an HSA at this point in terms of the order of operations that you kind of invest outside of a company match situation? But beyond that, is there anything else that you would put ahead of an HSA at this point?
Yeah, no, I love the HSA. I think it's great to kind of balance that out. One of the things that we look to do is, and for folks who have tons of money, it's easy. You just do everything, right?
Right.
But we want to have some things in just traditional taxable accounts because that gives flexibility for withdrawing prior to retirement, especially if there's early retirement, those kind of
Right.
things. But Roth IRAs are great when they're available to folks. When people exceed the income thresholds, then we're looking at, if there's an early retirement, taking advantage of Roth conversions during a lower income period. So there's a whole mix of different aspects. So we look at this as another arrow in the quiver, and one that we do put high emphasis on and look to try and grow for the folks, again, who have the cash flow to be able to do it.
Nice. I like it. No, I think it's a great tool. I think it's underutilized for a lot of people. And if it is used, it's used not long term, even though they might have the money to go ahead and pay the medical expenses out of pocket. I think people are just so ingrained into thinking, oh, this is a medical, bill. I need to pay it with my medical debit card because they give you a nice debit card usually. So no, it's definitely different than the flexible spending account, which, like you said, it's a use it or lose it. Definitely use those, but then this is more of a long-term strategy for sure. So
Yeah. Yeah, and you hit on it too. I mean, the biggest challenge for people is just kind of changing that mindset and thinking of this as like a healthcare 401k, and then paying attention to, yeah, I want to make sure I set up the automatic investing and I'm not just building up cash that isn't earning anything. This is an opportunity to really grow that bucket of funds, as well as take advantage of the tax deduction to make those deposits where people maybe aren't eligible for a Roth. They can actually do a lot more here in the HSA.
right. No, no, all good tips there. So no, this has been great. I appreciate you taking the time. Is the best way to reach out to you, is it through your website?
Yeah, yeah, jasonhowell.com.
Perfect. I'll include that on the description. Doug, always a pleasure. This has been great. I appreciate you taking the time to kind of get some education on HSAs.
Adam, great to speak with you as always. Thanks.
Always. All right. I'll talk to you later.
All right, take care.